Hi, and welcome to Category Management Knowledge Group's weekly Category Management Tip. If you don't know about Category Management Knowledge Group, we provide category management training solutions that are driven from a foundation of accredited e-learning courses. I love everything about category management, and each week I share some of my learnings on category management related topics. Last week, I talked about a break-even analysis to help both retailers and suppliers understand the volume required to maintain gross profit at different price points. It focused primarily on a retailer's perspective when looking at margin objectives and price points. So this week, the focus is on understanding the return on investment of a promotion and how it applies to the manufacturer. Until you perform a profitability or return on investment evaluation, you can't be sure that the promotions that you set up with a retailer will be the most cost effective. Higher prices usually result in higher gross margin percentages and lower unit sales. Too high of prices reduce store traffic, and it tells consumers that a retailer may be out of the pricing game. Lower unit prices will usually result in higher unit sales and lower gross margin percentages. Low prices might be considered the opportunity cost investment that's required to increase the everyday sales. The promotion may build brand awareness and positive response from consumers that may be reflected in everyday volume. But it may also increase pantry loading and cherry picking and reduce brand equity if the prices are too low too often. In net, it becomes difficult to find the balance between sales and profit for both the retailer and manufacturer, which, as with everything else, ultimately affects the consumer. I'm going to walk you through a supplier who wants to calculate return on investment requirements when booking a promotion. This supplier's product is sold to the retailer at a unit cost of $7, with a trade spend of 20%, which works out to $1.40 per unit or 20% of the $7 cost. So this 20% is the money available to spend on the promotion. The supplier needs to determine the units that the retailer needs to sell in order for him to break even on the promotion. To further complicate things, the retailer has different promotional options for the supplier to consider. In scenario 1, the supplier can pay a $10,000 flyer rate with no extra unit allowances spent. In scenario 2, the supplier can pay a $5,000 flyer rate and a 50-cent unit allowance for every scanned unit. And in scenario number 3, the supplier can pay a $2,000 flyer rate and a 75-cent unit allowance for every scanned unit. So which scenario should be picked, with a minimum to break even on the promotion and maximize sales, while ensuring that it's also profitable for the retailer? Let's go through each of these scenarios in more detail. The supplier has pulled retail POS data and captured the average units sold at each of the price points for this retailer and this product in the first two columns of this table. Next, the break-even rate can be calculated, which is the fixed cost, or $10,000 flyer price in this example, divided by the trade spend per unit of $1.40. So the supplier needs to sell 7,143 units to pay for the $10,000 flyer and break even. So this is where the break-even point is, in between the $8 and the $8.50 price point. Now, let's look at the profit results for the manufacturer at the different price points. The trade spend generations are the average number of units multiplied by $1.40, which is the trade spend generations per unit. Total profit for the manufacturer is calculated as the fixed ad cost of $10,000 minus the trade spend generation. And gross margin percent is captured in the last column, which is the total profit divided by the total dollar sales. As we already established with the break-even calculation, 7,143 units need to sell to break even, which is right where the gold line is there. So somewhere around the $8 price point is where the supplier starts to make money on this promotion. We also can't forget about the retailer's profit in this scenario as well. Their gross margin is driven off of the retail price minus the unit cost, multiplied by the average unit volume. This calculation does not include the cost of the flyer. So the $8.50 price point generates the most gross margin for them. Now we have scenario number 2, with a fixed ad cost of $5,000 and a unit allowance of 50 cents. So break even is 5,556 units. So anything below a $9 price point is beyond the break-even point, and the supplier will start to generate profit. The retailer maximizes gross margin at the $8 price point, and then the profit starts declining at lower price points. Finally, scenario number 3 has the flyer at a $2,000 cost and a unit allowance of 75 cents. So the break-even is 3,076 units before the supplier starts generating gross margin. For the retailer, they're making the most margin at the $7.50 price point. So we now have our 3 scenarios for the supplier. Scenario 1 has the highest upfront cost, but the biggest payout on lower price points, generated from the higher unit sale. But for the retailer, this scenario is most profitable for them at an $8.50 price point that doesn't work for the supplier to break even. Scenarios 2 and 3 have different price points that the supplier starts to generate margin. Once again, remembering the retailer's gross margin results. This example only gives you a glimpse of the complexity of promotional analysis. There are other things to consider when completing this type of analysis. The role of the product in the category. Items that are destination items may be used to drive traffic, and so lower margins or an investment may be acceptable. In my examples today, we looked at total sales, but promotion really should be analyzed based on incremental sales, because the baseline sales would have sold regardless of the promotion. Also, you need to consider the impact of pantry loading and post-promotion cannibalization on gross margin for both the retailer and the supplier. Finally, the anticipated number of units sold on a promotion based on averages at price points should be taken to a deeper level for more accurate predictions based on the type of promotion, the location in the ad, and so on. In net, there's not a simple answer when making promotional decisions. But by completing promotional evaluation analysis and considering results from both a retailer and supplier perspective, you can try to find the balance between the right promotions and the right price points to drive both retailer and supplier sales and profit. So that's it for this week's tip. Next week's session is going to be on baseline and incremental sales. You can also visit or subscribe to my blog if you haven't already done so at category-management.ca. If you're interested in category management training, we have related courses on pricing strategy and analytics, as well as promotion analytics that may help you if you didn't understand some of the things that I covered today. These courses are accredited by the Category Management Association and are really valuable courses that you may want to consider taking. Finally, we're very active in LinkedIn, Facebook, and Twitter, so please connect with us. Thanks, and I hope you have a great week.